So it's just taking time for these excesses to be wrung out of the system. But we still have a massive asset bubble in stocks, a massive asset bubble in credit. And those things have to be equalized. They have to be wrung out, normalized. And that's not going to change. That has not happened yet. It will happen. And my portfolio and strategy is about getting the timing correct. But please understand, I am very negative on the foundation. I have been, I remain very negative on the foundation of this economy, which is built on asset bubbles and debt. That has not changed, and it's not going to change until they correct. What always drives gold is falling nominal and real interest rates. That's what gold is most concerned of. And you see that the rates are falling. Rates have crashed. The long-term rates have crashed. So gold actually absolutely loves that. Let's be clear. The average stock hasn't done much at all. If you look at the Russell 2000, it hasn't done much since the end of 2000 or start of 22, the start of the end of 21. Sectors in the market are hurting, like the banking sector, regional banking sector. So it hasn't been a overall crazy bull market like it was for Nvidia. If you want to extrapolate that return and for the overall market, it looks like we're doing great. But there are sections of the market, parts of the market that are struggling. But we are not participating in that. We have a 5-sector portfolio that ranges from deflation to stagflation or hyperinflation. We were in sectors 3 and 4 a few months ago after we spoke. Our portfolio participated in the upside there. We then since went back into sector 2 very recently, which is disinflation. And I think there's a very good chance that we could head into deflation in the very near future. But I'll let the model that I created, called the inflation, deflation, and economic cycle model and strategy, I'll let that model dictate when it's time to get short the portfolio. And as I want to stress, I have not been short the stock market since 2022 in a net basis. What I do is I actually buy ETFs that go up when the market goes down. And a couple of the ETFs that I have actually will do the shorting in a type 3 margin account for me. I also have gold as a hedge. I have yield curve steepeners as a hedge. There's a anti-volatility fund that I use. So I am in some of those things that I just mentioned right now. But as an out and out short, which I use, like I said, these either inverse ETFs, which you have to go in and out of them. You can't hold them very long. Inverse ETFs or the straight short ETFs. I own none of those right now, except for a very small short in high yield. I am short the high yield market because I just don't see any upside there at all. When you think about the 5 sectors that range between deflation and hyperinflation, disinflation has its own bucket as well. That's sector 2. So you want to avoid high volatility sectors in the portfolio. You want to avoid high beta. You want to avoid things like tech or small caps when you are disinflating. But when you retreat to sector 1, which would be deflation, which you would see a minus sign on that chart, then you want to head towards the 4 horsemen of the economic apocalypse, as I call them. So you want to have only treasuries, you want to own the US dollar, and you want to be short the market, high levels of cash, and you could actually have a yield curve steepener. So those are the only things you really want to own when you're in sector 1. We're just not there yet. And the reason is, Kai, and again, I want to stress, I might sound like a Cassandra here, calling for the end of the world, I'm not calling for the end of the world. I'm just stating the obvious. And again, I run money for a living. So if I was net short the market on a persistent basis since 2022, I would be out of business. So I have a model that tells me when to get net short. We're just not there yet. But we haven't solved any of the problems. The problem is that it's taking a lot of time to get all the liquidity out of the system. So for example, from 2020 to 2022, the Fed's balance sheet, also known as high-powered money, went up by $5 trillion. The M2 money supply increased by $6 trillion in 2 years. That's some 30 something, like 35% of increase in M2 money supply in 2 years. That just has never happened before. And if you see, a lot of that money went into the financial system, went into the banking system. They're loaded with excess reserves. They parked those reserves at the Fed. There was $2.5 trillion in the reverse repo facility. That's down to $300 billion today. So and the M2 money supply stopped rising. It hasn't. It's kind of stayed flat for a couple of years now. So it's just taking time for these excesses to be wrung out of the system. But we still have a massive asset bubble in stocks, a massive asset bubble in credit, and those things have to be equalized. They have to be wrung out, normalized, and that's not going to change. That has not happened yet. It will happen, and my portfolio and strategy is about getting the timing correct. But please understand, I am very negative on the foundation. I have been, I remain very negative on the foundation of this economy, which is built on asset bubbles and debt. That has not changed, and it's not going to change until they correct. And by the way, they should correct 40% just to bring those ratios of home price to income ratios and stock prices as a percentage of the economy. 40%, both those things should correct, just to bring them back to an historical normal ratio. The Fed is definitely behind the curve. The free market has already moved the 10-year note down to 3.8%. The Fed funds rate is 5.3. An effective Fed funds rate is 5.3. And the 10-year note is 3.8%, 3.9, around there. So even if the Fed went into some kind of quasi-aggressive rate cutting cycle. So suppose they went from 4.25 to 4.5, that's their target range now, down to, say, 5.25, 5.5, down to say 4. That's still would be an inverted yield curve. And the free market has already priced that in. The Fed has well telegraphed this decline in borrowing costs. So, I mean, yes, of course, people do borrow at the Fed funds rate. So home equity lines of credit, credit card, auto loans, they would be affected positively by that lowering of interest rates. But every other borrowing, corporate debt and mortgage debt, they've already crashed. So I think the danger is Wall Street has priced in 14% earnings growth for 2025, 12% for this year, and it's just not going to happen. The economy is growing very slowly. It's growing with a 1% handle, according to my calculations. The leading index of economic indicators just came out today and showed that we should be growing, well below trend. Inflation has come down, as you say it, as the official measures have it, below 3%, from 9%, which was in reality 18%, the way I calculated it. The way Shadow Stats calculated it was close to 20% as well. So you're just not going to get the revenue and earnings growth. What always drives gold is falling nominal and real interest rates. That's what gold is most concerned of. And you see that the rates are falling. Rates have crashed. The long-term rates have crashed. So gold actually absolutely loves that. I think the next leg is a recession. That'll take rates a little bit lower on the long end, a lot lower on the short end. Because I think the Fed funds rate could go to 2%. Right now, the 2-year note is over 4. So that's wonderful. But you hit the nail on the head when you asked me the question. You said, is the United States an insolvent country? Insolvent nations tend to have a very bad relationship with a currency and a very bad relationship with gold. Gold is the true revealer of how well a nation is doing with its stability. And we're doing a very poor job of it. So I expect gold. Listen, if you ask me if Bitcoin, which is a 64-bit private key, which has letters and numbers in it that exists virtually, if that could be $60,000 a unit, then gold could be $5,000 or $6,000 an ounce.